It's almost the end of February and it's not a leap year, so I won't be proposing to my master investor colleague, Jonathan Davis, primarily because I think Mrs. Davis would have something to say about that. And Jonathan, I never get
I hope you're right about that. I'm not so sure, but I hope you're right about that.
I never get my honey where I get my money, but I think that's oversharing. But February, lots of excitement this month in terms of big, round, tantalising, juicy numbers. 8,000, the FTSE 100 almost breached its next resistance level, but we didn't quite make it. What was holding the market back from getting into the next level?
Well, the FTSE has not done badly this year. It's up around 6%, I think, this year, something like that. And as you say, touching these close to these all-time highs. But mind you have to go back. 2018 was the last time that we were at this level, the target we have to breach. And before that, you have to go all the way back to 2000. So it's been a long, hard slog for the UK market, and so a little bit of 6%, so far this year. That's encouraging. But the UK market is a very small part of the world equity index. It used to be 10% sort of back in 2000. Now it's under 5%. And most international investors, it's hardly a blip on their radar. And until we get a lot of external, foreign investors coming back to the UK market, it's not going to go roaring ahead, I don't think. And if you look at the valuations, they are cheap compared to a lot of other countries' markets. But in the old days, we had a sort of golden rule. When the yield was, the yield ranged between 3 and 5% on the FTSE, and when it was 3%, it was expensive, and when it was 5%, it was worth buying. And it's currently on a PE of 12.4 times and a dividend yield of 3.9%, which is sort of bang in the middle of the range. So it's kind of quite good value, but it's not particularly good value. So I think it's going to be quite a struggle to make a really decisive breach through the all-time high, though, from a technical point of view, it looks quite good.
Is it all to do with the B word, do you think, Jonathan, Brexit? Because you talked about the UK market being almost like a minion in terms of the rest of the world sort of indices. Is it because of Brexit? And I know at the moment that Rishi Sunak is on the cusp of a post-Brexit deal. Do you think if he brokers a deal that our market may be taken more seriously?
Yeah, I'm sure it might be a factor. I think, the Brexit factor has been there for a while. It certainly was a factor back in 2016. And it's one reason why the UK market remains, relatively cheaply valued compared to the rest of the world. I don't think a Brexit deal will make a particular difference. I mean, it only really affects trade into Northern Ireland. That's pretty, that's absolutely minimal in terms of the world economy, though it has some important political ramifications. So I don't think it's very much to do with Brexit. I think it's to do, the way the UK FTSE index performs is a lot to do with the makeup of the index. And it's if it's it's got a lot of miners and banks and big, rather kind of low growth companies. And I think it's really reflects the fact that the UK economy is a relatively low growth economy with a susceptibility to inflation, and that hasn't really changed. So I don't think it's really about Brexit anymore. I just think it's about the kind of market we have. I mean, it's worth comparing the FTSE with the UK small cap and mid cap indices, which reflect the domestic economy. They're still down quite a lot over since the start of last year, and we're in the slow lane, I'm afraid, at the moment, and have been for a while.
So in terms of the domestic economy, what are the trends? Because I understand that a very learned survey came out last week, which on first hearing sounded like dim sum, but it's not that, is it?
Not dim sum, no. It's not dim sum. It's not a culinary treat. A survey. It's an annual study that comes out from 3 academics from London Business School who've been well-known people called Dimson, Marsh and Staunton. So that's Elroy Dimson, Paul Marsh and Mike Staunton, 2 professors, former, retired professors now. They've been around for a long, long time. Helped to discover in fact, designed the FTSE 100 index, believe it or not, which was introduced in the early 1980s, as I'm sure you'll remember. and the first market capitalization weighted index for the UK market, and that was designed by Professors Marsh and Dimson. Anyway, they do this annual study of long-run historical returns from equities, bonds, and inflation all around the world, global investment returns. It's called the Global Investment Returns Yearbook for that reason. And every year they add a couple of sort of features to think about particular themes. And it's always interesting. I mean, because, you know, there are some long-term parameters around investing in equities, bonds, and property and so on. And they kind of hold you within limits. And you can see where we are relative to where we've been in the past. And I have to say, unfortunately, this year, their message is quite gloomy. I mean, they've been talking about the you know, the real rates of return that you can expect from your investments. In other words, after taking account of inflation. Inflation obviously has gone up, as we all know, last year, and is coming down, but we don't know how fast or how far it's going to go. But anyway, they do some calculations based on their sort of expected future returns from the major asset classes. And they are saying that from here, or at least for Generation Z, that's the most recent cohort, returns are going to be lower than they have been for, you know, the baby boomer generation, my generation, which have done exceptionally well by historical standards, though we didn't know that when we were born. So just to give you a number on that, if you take a 60-40 portfolio and the expected, well, the premium, if you like, the excess rate you make from a 60-40 portfolio after allowing for inflation for baby boomers has been 5.6%, which is in real terms, that's a kind of long run rate of return. And for Generation Z, it's only going to be 3% if you take a 60-40 portfolio. And if you compound that over time, that does mean that you know, the latest generation, the youngest generation, are not going to make as much money from their portfolios over the next 20-30 years as we were lucky enough to do. So that's a kind of sobering message, if you like. It just reflects the fact that interest rates have been so low. Real interest rates have been negative for a while, thanks to central bank policy, and it's a very short-term policy. It's taking from, you know, it's taking from the younger generation in order to give to the older generation. And I think that, you know, the bill for that's going to come in, and unfortunately, it's going to be paid by the younger generation.
Okay, so what can the younger generation do? How can they make their money? Are they all going to become social media influencers and live off the advertising revenue, or, you know, get down to pit? I mean, what can they do? Should they just forget about investing as you and I understand it?
No, I don't think they should forget about investing. I mean, to be fair, I mean, this could all change if it's all a question of when you get your money into the market. Now, if you're still young, okay, you're still at the early part of your working career. If you put some money into a pension, that will do fine. But the early part of it won't make as much money as the later part. So if we have next time we have a really bad bear market and a real crisis of some sort, that will be the time to put more money into your pension if you're a young person. You definitely should be investing, because even any kind of positive real return over the longer term is going to be helpful to you when you're old. And you are going to live a lot longer, you know, unless on current trends you're going to live to be 100 probably, if you're born in the last 20 years or so. Good chance of being living to 100 if you're in good health. So, you know, you've got to be investing, but you've also going to have to, you know, you're going to have to work harder and longer, I'm afraid. So, you know, what would I recommend? Well, I mean, you could sort of bump your parents off. That would be quite a good thing, because the flip side of all this is that the baby boomer generation has got a lot of money. Or maybe your grandparents. Start with the grandparents first. You know, slip something in their tea. That would be quite helpful, because then you can inherit quite a lot of money and to kickstart you on that way, because there is a lot of accumulated wealth in the older generation. So that would be a start. But then, I mean, you just got to, you know, do what you do. Obviously, helps to be educated. It gives you a better chance of getting a good job. You know, you can still become a lawyer, for Christ's sake, and you know, lawyers are doing okay, and all these other things. But you know, hopefully, they're all going to be entrepreneurs and make lots of money for the wealth of the country, even if it means having to travel abroad or, you know, whatever. But you know, keep the faith. Keep the faith.
Okay, well, if they can travel abroad, again, you know, that Brexit word. And I'll just slip in a quick disclaimer here. We're not encouraging you on this podcast to actually do as Jonathan suggested, please don't slip anything into your grandparents' or your parents' tea. It's just a joke. Now, earlier on, very crassly, I said, go down to pit. Now, I am a colliery girl. And when I was growing up, commodities was coal, coking coal, smokeless fuel, which is what we used to use to keep the house warm. So in terms of the survey by Mr. Dimson and friends, what did they have to say about commodities? Because of course, commodities is much more than coking coal and fuelless energy.
Right. Yeah, you're absolutely right. There's so many commodities, different types. We've got precious metals, we've got soft commodities, food, agricultural, and we've got energy. Those are the main ones, and they're all have different characteristics, and that's the interesting thing about them. But you could, you remember all those movies about investing in commodities back in the 30s or even in the 19th century. People have always been drawn to commodities, but the historical evidence is clear that if you invest in individual commodities, i.e. oil on one hand or metals or whatever it might be, the long run return from commodities is basically around zero in real terms, the long run return. And that's because they are commodities. So, they're generally available. And if the price goes up, you get more of them because people produce more of them and so on. So that's been well known. But what interestingly they found in their long run historical survey of commodities is that if you invest in commodity futures, derivatives, you never actually take delivery of these products. But if you invest in futures, collateralized futures, slightly complicated to explain that, but basically they found that was much better way of investing in commodities. Individually, they all make some kind of positive return with volatility and so on over time. But if you actually own a basket of them all, an index of them all, in theory, you get actually better returns than you do from investing in equities. And who would have thought that? So a collateralized index of commodities over time will produce very, very good returns. And more than that, the other point they make, which I think is interesting, and people don't often get this right, is that commodities are, at least this way of investing commodities, is an effective inflation hedge. And that's really not surprising, because quite often, if you look back at our periods of high inflation, they've been driven by periods of high commodity prices, and commodities do well in periods of rising inflation, which is not the case for equities, bonds, and property. We all say that equities and property are real assets. In other words, they do make a positive real return after inflation over long periods of time. But actually, during periods of inflation, they're not an actual hedge. In other words, they don't compensate you fully for the impact of the inflation. So, and I think we're seeing that at the moment. Equities are a real asset, but they haven't really protected you against this recent inflation. Far from it. Last year down 20% or whatever it was. So commodities are a place to be, and you need them if you want them as insurance against inflation. They are the only effective hedge other than gold and precious metals, which also have that effect of having some positive negative correlation with inflation. So it's a very, very positive correlation with inflation. It's a very, very interesting observation. Now the problem is, you'd say to me immediately, well, how do I do that? How do I buy this index of collateralized futures? And the problem is, you can buy an ETF, but they're not a perfect match for what the strategy that their professors are talking about. And the other problem is that, unfortunately, supply of commodities is limited. So if everybody did it, just as with every other kind of investment, if everybody does something, price comes down, too much demand, the effect would probably go away. And something similar happened in the 1980s with these two professors. They also were one of the few first academics to highlight this, what's called small cap phenomenon in the UK, which is that small companies on the whole do better over time, more than you would expect, even allowing for risk. But when they announced they discovered this in 1985, everybody piled into smaller companies as a result, and the effect disappeared for about 7 years. So you didn't actually get the benefit of it because the herd was going into this thing. But the general principle remains true, that therefore, commodities are something useful to have in your portfolio as a diversifier. And the way you do that, some of the indices you can get ETFs, Goldman Sachs have a commodities index, and so on. But they're not perfect, unfortunately, ways to replicate this. but it does underline this point about diversification and an inflation hedge, which is what most investors need.
So I'm assuming that this survey is an annual one because, of course, we are now, it's 1 year into the Ukraine, Russia's invasion of Ukraine, and of course this month we've had the awful earthquakes in Turkey. So the survey, does it point to reference larger macroeconomic events as having significance on investments and markets?
Yes, I mean, over time, that obviously is the case. And if you look, the most obvious examples are wars, First and Second World War, and a revolution. So, the Russian stock market, came to an end in 1917 when the Bolsheviks took over. And similarly, the Chinese market was closed for a long period when Chairman Mao came along after the war. So, bad things do happen. And that's one of the messages they have. They're very, of course, being academics. They take a rather kind of what's the word I'm looking for? Slightly kind of ivory tower approach to this. But they do. These points are important. If you invested in Russia last year, for example, the market's been closed. You can't get your money out. Bad things do happen, and that's another argument for diversification. So they're big proponents, obviously, of global diversification. You want to have money all over the place so that you don't suffer when things go bad. And yeah, famine would be a good example. Wars are the most extreme example normally. There's no doubt that the war in Ukraine will have a long-term consequence for stock market returns. But that's life. That's what comes around. And if you've got a long-term historical perspective, I think the difference is you'll realize that these things do happen. The pandemic happened, another example. Many people, when they start investing, they have this rather sort of naive view that if only they get the right thing that's going up the most, they will do well. Well, you should mention Bitcoin, a good example here. If you think you're going to make all your money out of Bitcoin over by investing just in that, you're slightly delusional, I think it's fair to say. Though Bitcoin has performed well in the last few months, and no doubt the animal spirits in the Bitcoin community are rising again. But history suggests you don't want to put all your eggs in one basket, certainly not a very untransparent one like Bitcoin.
So finally, Jonathan, I know that you don't operate on a calendar month-by-month basis, but we are just going into March. What are you looking for? What surveys might come up on the March horizon?
Okay, well, March is always an interesting month. It's the final month of the financial year. It's when people tend to make their investment decisions. They all leave it to the last moment of the year and then decide what to do with their ISA and so on. Not a very good idea, actually, in principle, but much better to do it in the summer. Summer tends to be slightly weaker than in this period because everybody is putting their money in at this stage. So what am I looking out for? Well, we've got a budget, of course. We want to see whether, whether taxes are going up as much as we think they are. Whether any changes that might be relevant. They are going up, from next financial year. So you need to be aware of that. I suppose the question is, what's going to happen to the markets this year? I'm still fairly negative about that. But you tend to often get a very strong period in the first 3 months of the year, and then it fades away during the summer and comes back in the autumn. I would expect that to happen. But the big news will continue to be what's been, preoccupying us now for the last 15 months, which is central banks. What are they going to do with interest rates? Inflation, how fast is it coming down? And how are companies, performing? We haven't yet seen whether the company earnings are going to come down as many expect, or whether by some miracle we're going to see avoid this recession or hard landing that more conservative, anxious investors have been worried about. But so more of the same, I'm afraid.
Okay, Jonathan, thank you very much. It's always a pleasure, and I hope that Mrs. Davies doesn't give me a bunch of fives. Give me what for my provocative intro earlier on. Thank you.
Not at all. Well, we'll find out. If we don't have another one of these, you'll know what's happened. Yeah, absolutely. Or maybe my children have taken, my grandchildren have taken my advice, and they've combined to slip something in my tea.
Oh well, let's not have a morbid March. I look forward to speaking to you the same time at the end of March. Thank you, Jonathan. Appreciate it. Thank you.
Not at all. Pleasure.